Hi, I'm Jimmy. In this video, we're going back to the basics. This time, we're looking at what is a required rate of return. So we're going to look quickly at the definition of what a required rate of return is. We're going to look at what an example is, and then we're going to look at the impact that changing a required rate of return has on the fair value of a stock, and ultimately how we can use this to make more money. Okay, so now let's jump into the definition. So the basic definition of what required rate of return is exactly what it sounds like. It is the minimum return on a percentage basis we need as investors. So let's look quickly at an example. So let's imagine that we need to return a minimum of 9% per year. That is, and this is our discounted cash flow calculator, right? So our required rate of return is right now 9%. Well, basically what a discounted cash flow calculator does, or any type of fair value methods, say, okay, in this case, what is free cash flow going to be in the future? And if I need to return 9% every year, on average, 9% a year, what should I pay today? In this case, we get a fair value of $122 per share. So the required rate of return, the fair value, assumes if we pay exactly $122 per share, and everything else, the future estimates pan out exactly as we've predicted, well, over the long run, we will average 9% per year. Now, what if we don't need 9% per year? What if we need a lower return? What if maybe we have more cash up front, we want to take less risks? Well, now we want 7% per year. Well, just like that, the fair value is $197 per share. That's the key impact on how the required rate of return impacts the fair value of a stock. If we need a lower return, we can pay a higher price. Well, what about the flip side of that? What if we don't want 9%? We certainly don't want 7%. We want even more. We want 11%. The market, after all, is averaged about 9 or 10%. We want 11. We want to beat the market. Well, we have to pay a lower price. Right now, we could see that using an 11% required rate of return, well, now the fair value drops down to $82 per share. So required rate of return is crucial in that it has a huge impact on the fair value of the stock in general, but it helps set our sort of benchmark, what we want to do. If we want to invest in a riskier company, we should increase our required rate of return. If we want to invest in something safer, perhaps like a bond, well, we could decrease our required rate of return. That is the advantage of using required rate of return. Now, if we didn't want to adjust our required rate of return, we want to keep that number flat, the other option is to adjust, after we determine the risk of the investment, is to adjust the margin of safety. We recently did a video on margin of safety. I'll leave a link to that video in the description below if you're curious. Now, if you'd like to get access to this website, help you calculate the fair value of a bunch of different stocks quickly and easily, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.